Before the coronavirus pandemic, state pension plans across the country were already short on funding. And now some companies are choosing to cut their pensions to help cut their losses from COVID-19. That could have a huge impact. We're talking teachers, firefighters, police officers, and other employees who receive a pension. So Trevor Wilde with the Wilde Wealth Management Group joins us with some financial tips. And first, thank you very much for joining us. But why were they already falling short before?
A lot of factors go into the shortfall that occurred. Many organizations believe that most public pensions were as much as $1 trillion underfunded coming into 2020. That's before the pandemic. And a large factor of that is people are living longer, and longevity as you retire and are drawing that pension over 30 or 40 years has a very large impact on how these pensions are funded.
So add in the coronavirus pandemic. How does that switch and change everything from there?
I mean, it's a scary situation. We all know what happened to the investment markets, and you have to remember these pension plans are investing these assets much like you have your money invested in your 401k. And the market reaction that happened early in the year when COVID hit was significant. We're trying to understand what the estimates would be. Many believe that the impact to the pension funding could hurt pensions as much as another 20 to 30%. Now, the market rebound has been significant, so we have to continue to watch this.
Yeah, I was going to say, so the federal government dumped, what, $2 trillion into the market to make sure it didn't crash. How does that play into the pension program?
Well, clearly the government's interaction helped stabilize the markets back in March. And as we've been watching, the markets have had a tremendous rally back to really where we were pre-pandemic from a market perspective. Obviously, this is going to have a big impact on these pension assets. The question is what happens as we move forward?
Yeah, that's a big question. So what should somebody who's already invested into a pension and obviously they're waiting to retire, thinking they can retire on that money, what should they be doing right now?
Plan. You know, what we try to talk to our clients in different groups. If you're getting ready to retire in the next 2 to 5 years, I think being aware of the pension funding, pay attention to the funding notices that come out every year, and really plan around what happens if this pension gets reduced or goes away. Our younger clients that are 15 to 20 years or more away from retirement, we would really prefer to have a plan where we're not counting on fixed programs like Social Security and pension plans. Now that's challenging, so it's just about planning and trying to be as responsible as we can with investing and saving.
What happens if these pensions just run out altogether? Do the people who have opted in, do they just not receive any money?
So there's two different classifications of pensions. We have public pensions and government and local pensions. Pensions that are provided by publicly traded companies have a benefit guarantee corporation that would step in. It's very unlikely that someone receiving a pension would receive nothing, but there could be cuts. Most analysts believe that on the public and local side, the chances of seeing pensions go to zero is next to nothing, but there could be significant reductions depending on how this goes.
Yeah, and if you're counting on that money, wow, that's going to be a big, rude awakening. Yeah. All right, we thank you very much for taking the time and bringing this information, and most importantly, we'll put all your information on our website in case somebody needs to get in touch with you to help.
Great, thank you.
Thank you, sir.